here. Hope you're doing well. Welcome to another live stream. Today we're going to be talking about inflation because there are some developments over the past couple of days which lead me to believe that inflation will be rearing its ugly head once again very soon and in a very big way. And we're going to get into several of those reasons today. Some perhaps more important and more pressing than others. Of course, if you would like to hedge against inflation, you can check out sdbullion.com. You can buy your gold and silver there. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And they do still have that 72-hour sale going on where they've got the 2023 Britannias on sale for $279 over spot. So if you're thinking about doing some stacking, I think that is a good opportunity to take advantage of. All right, so today's lead story, and I've got several interesting ones to go over with you, but today's lead story, perhaps the most important, is this one. India has imposed a rice export ban. So I believe they are still exporting white basmati rice, but all other types of rice they have stopped exporting. Now, what does this have to do with inflation? Why is this important? Well, let's talk about it because this is a sign of, I think, one, something that we're going to see more of this food protectionism, because the reason that they are imposing this ban is to help keep their domestic prices for food low. But if you want to know why it's so important that India has banned these rice exports, just look at this chart. This is a list of the top rice exporters around the world. And you can see, I mean, India there dwarfs even the number two exporter by a long shot. So the world's number one exporter of rice, providing something like 20% of the total of global exports or more than that, has banned their export. So clearly, this has some significant implications for food prices. If the rest of the world can't get access to all of that exported rice, it's not. If they stop exporting, say 5 or 10 or 20% of the global price that or the global rice, that doesn't mean that the price goes up by that percentage. I mean, that could drive the price drastically higher because you know the rice goes to the top bidder, whoever that happens to be, and there are folks who will pay a lot for food because they need to eat. And so if the supply gets diminished significantly, you could see massive increases in the price of rice. Now, this is a headline from Bloomberg from 10 hours ago. Panic buyers load up on rice supplies as India bans export. So, from US to Canada to Australia, according to this report, there is panic buying going on, with some shops being forced to implement limitations on what people can buy. These supply chain disruptions, they've kind of moderated from the era of 2020, 2021, but that was one of the factors that was driving prices higher over the past couple of years. And so it's looking like we may be returning to an era of supply chain disruptions. Now, when it comes to food, it is not just India which is now reducing exports. We've also got Russia, who has canceled this Black Sea grain deal by which they were allowing the export of grain, of wheat, various other grains from these Black Sea ports, which apparently now the Russians are saying that their requirements for their part of the deal, the other part of the deal, wasn't being held up after having this deal in place for some months, and so they have canceled that. So this is another indication that we are going to be seeing rising food prices over the next several months. Now, right now, everybody is focused on what's happening tomorrow with the FOMC meeting, excuse me, and the announcement by Jerome Powell and the other folks on the FOMC as to how much they're going to be hiking rates here in the U.S., hiking the federal funds rate. And it seems like the consensus is it's going to be another 25 basis points, another quarter interest rate hike. And very likely that's what we're going to see. And, the thing is that everybody seems to think that the Fed is going to be able to get inflation under control by hiking rates, in a fairly small amount. I mean, if you look at historical rates, they're still kind of low. But it's important to remember that the things driving the high inflation, which we've been experiencing over the past couple of years, yes, the Fed keeping rates artificially low for too long was certainly a contributing factor to that. But you have to remember the reason why the Fed was keeping rates so low. It wasn't just to arbitrarily keep rates low, it was to accommodate the massive deficit spending in Washington. I see some folks chiming in. Jeff Tooley, Tiger Thomas, one of our channel members, saying hello in the chat there. Hello to you and to everybody else. Please do smash that like button, by the way, if this information is helpful for you, if you enjoy this video. I really like these live streams, really appreciate everybody who participates by putting questions and comments in the chat as well. So please keep that up. But it wasn't just the Fed keeping rates low for so long. Again, this is certainly a contributing factor, but the real reason that rates had to be kept so low for so long was to accommodate all of the massive government spending, the huge deficits, the $32.6 trillion in debt now that we have accumulated because, of course, when you are borrowing tremendous sums of money, trillions and trillions of dollars, higher interest rates makes that kind of difficult. Higher interest rates are, the harder it is to borrow more money, right? Because you got to pay more interest on that. Now, I've mentioned this in recent videos, but it's worth taking a look at once again. We are now learning that hiking interest rates when you have this massive amount of debt to service is certainly detrimental. And this is a chart of the federal government expenditures in the form of interest payments on the national debt. And you can see that, I mean, it's absolutely massively spiked up, gone parabolic since the Fed started hiking rates. And unless the Fed cuts rates soon, this chart is going to continue to look much worse. Now, I fully expect that the Fed is going to eventually be forced to pivot, probably sooner than later. And this is really the primary reason why. I mean, just because the interest payments on the national debt, if they continue to hike rates, they're going to become the single biggest item on the national budget. And the real contributor to inflation here is the deficit spending and the massive debts, the massive creation of money, the pulling of money out of the future and putting it into the economy now. This is really the big contributor to inflation. So we still have out of control fiscal policy. Very likely we have a Fed that is ultimately going to need to pivot. And now the supply chain disruptions are rearing their ugly head once again. Now, I got another chart for you. I know everybody likes charts. I like charts. Let's see. Someone put in the chat, I hear no pivot until Q3 2024. Well, maybe. I mean, it's possible that they could keep hiking rates until then, but the thing is that they will pivot eventually. And when they do, I don't think they will have made much progress in terms of reducing their balance sheet, for example. Perhaps they will have managed to trigger another banking crisis or financial crisis by continuing to hike rates, but that's all they're going to do. And if that crisis happens to manifest itself before Q3 of 2024, well, the Fed pivot is going to manifest itself then as well, because, as soon as the banking failures resume, and, keep in mind, we are still in the midst of the worst banking crisis since 2008. In fact, it's already worse than 2008, and the year's, not over yet. I did a video yesterday about the BRICS currency and their meeting. We got that coming up too. So there's plenty of threats to the dollar here and to our economy, which may force the Fed to intervene in one way or another. But this is another chart I wanted to take a look at. This is actually a chart of the CPI. And you can see the blue line there is the CPI, and then you've got the red number, the red line, that is the core CPI. So that is less food and energy. And if you notice, the core CPI really hasn't come down that much. I think it was 4.8% in the last readings, but still considerably higher than the non-core CPI, which does include food and energy. And part of the reason for that is because we have seen a tremendous decline in the price of some of these food commodities and also in energy from their peak back in 2021, 2022. For example, look at the decline in the price of crude oil from its peak in 2022. I'm trying to get this chart pulled up here for you. Not the best chart here on Yahoo Finance, I guess, but you can get the gist of it here. We're at about 79 bucks right now, and at the peak we were over 100. I don't think that's showing up on this 1 year chart. Yeah, here, if we pull up the 5 year, we can see it. So peaked well over 100 bucks. It's come down to, was down under 70 for a while there. Now, of course, it's beginning to resume its climb up. The price of crude oil now back up to almost $80. That's WTI. I believe Brent is somewhere around 82 right now. So certainly, we are beginning to see the price of crude oil, and now after these supply chain disruptions by India and Russia, it's very likely we're going to begin to see the price of food rising as well. We've already got panic buying, and unless they resume exports of rice and unless they resume those exports out of Ukraine of grain, we are very likely to see basic foodstuffs rising, and that is going to cause the CPI to rise back up to levels perhaps exceeding the core CPI once again. This is an article from oilprice.com. The SPR could stay half empty forever. So right now, the Strategic Petroleum Reserve is sitting at about half of the levels from its peak. And this is very interesting because a major contributor to the decline in the price of crude oil that we saw was this constant release of oil from these SPR. It was something like 300 million barrels of oil over the course of a year or so. And now it looks like we're not going to be able to fill that up. It says, according to the headline here, replenishing 300 million barrels at a cost of even $70 per barrel would cost $21 billion just for the oil alone. Forget, transporting it. Forget the fact that the price of oil is now well above $70. But so it's looking like we're not going to refill the SPR, and part of the reason is because, the reason that they released the oil from the SPR in the first place. They were doing it to try to combat inflation. Now, unless they want to drain the SPR completely, that, weapon is more or less exhausted. I guess they've got another 300 million barrels or so left in the SPR they could release. But again, this is not a sustainable solution for higher inflation. And now it's looking like that attempt to reduce inflation is over. So now we've got rising crude oil. Also, we've got these production cuts from Saudi Arabia and OPEC Plus, including Russia. They have all cut their production in an attempt to bring the price of crude oil back up because, of course, that makes business more profitable for them. We've got the SPR, which has already largely been drained. So no relief there. And now we've got major food producers and major exporters of food halting the export of those food commodities. So this is very likely going to drive inflation much higher. Now, you look at something like the price of silver. I'd like to pull up some of the precious metals charts for you here. Silver is massively undervalued. I talk about this, excessively probably on this channel. But look at, say, the price of gold, for example, here. The price of gold, pretty good day today, actually, up 15 bucks. It's, stubbornly staying just under $2,000. It was over 2,000 for a while. And this is close to nominal all-time highs for the price of gold. But then look at the price of silver. It's, look at the auto rotate on here. The price of silver, 24.87. Now that is about half of the nominal high that was hit back in 2011. So to me, silver is still massively undervalued. And I think that one of the things that could help bring silver around, maybe not to fair market value, but to a more fair market value, a less ridiculous low price, is the realization by investors that inflation isn't over. These Fed rate hikes, they are temporary fixes at best because we haven't fixed the real problems here. We really haven't even fixed the supply chain issues. They're continuing to break down. We've got de-dollarization around the world as the BRICS nations and the global south and all of these countries around the world are dumping the US dollar. And we've got deglobalization occurring because of the geopolitical situation we find ourselves in. We're on the verge of World War III. We've got NATO operating in Europe, record high troop levels there, the conflict in Ukraine not going anywhere. We've got a potential conflict with China in the Pacific there around Taiwan. This is not news to anybody. And we also have the Fed, who is continuing to, or I'm sorry, rather the federal government, who continues to just spend huge sums of money, the massive deficit spending. So all of these things are going to continue to drive inflation much higher. And I think that once investors realize that that is the case, and that, this decline in the CPI that we've seen down to the 3% level or so, the core CPI getting down to 4.8%, it may be done. The decline in inflation may be over, and from here on out, we may see those numbers begin to run back up. And that's going to be a real shock, I think, to the markets, because the Fed has got everybody convinced that this disinflation narrative is a sign that their rate hikes are effective at bringing down inflation, and I just don't think that's the case. And when ultimately that becomes clear, I think there could be a real rush into precious metals when investors realize just how bad this inflation problem is, and how we're really not addressing any of the core causes of this, and that higher interest rates at the federal funds rate level is not going to solve the problem. So anyway, this is going to be a little bit of a shorter live stream. That's all I got for you today, but I thought that that was just worth touching on. I mean, world food supplies. That's kind of scary when you start seeing the number one rice exporter in the world cancel all exports. So, maybe you want to stack some rice too and some food. And, I'm not saying that sarcastically or tongue in cheek. I really think that that is an important thing to prepare for as well. The coming food inflation, they say you can't eat gold and silver. So make sure you're topping off all your preps on this news and take advantage of the fact that the dollar hasn't been completely devalued yet, and go out there and get some of the stuff that you're going to need. The preservation of wealth with precious metals, gold, silver, to get you through this next inflationary wave, and also food and basic necessities so that you can continue to eat despite the fact that our currency is being wiped out. So that's it for today, everybody. Thank you very much for tuning in. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.